right? The big wins, the stocks that are just going to shoot to the moon. But today, we're going to talk about something else, the unsung hero of your portfolio, the one tool that's designed not for glory, but for survival. Yeah, we're talking about the stop loss.
And that quote really says it all, doesn't it? Stop losses are not about getting rich quick. They're about not getting poor quick. Think of them as your pre-planned defense system for when the market, and you know it will, gets a little crazy.
Honestly, the best way to think of a stop loss is exactly like this. It's your capital's airbag. You set it up, you really hope you never need it, but man, are you grateful it's there when a crash happens. It is literally an automatic safety system for your money.
So let's really get into it. The problem is simple. Markets are unpredictable, and when things go south, our own emotions can paralyze us, stopping us from selling a losing stock. The solution? A pre-installed, logic-based tool that yanks that emotion right out of the equation.
Okay, here's the textbook definition. A stop loss is just a preset order you give your broker. You're telling them, hey, if this stock drops to a certain price, sell it. That's it. This means the decision is made when you're calm and rational, not, in the middle of a full-blown market panic. It's your autopilot for discipline. All right, so not all airbags are built the same. There are different kinds of stop losses, and they each have a really specific job. Let's pop the hood and take a look at the two most common types you're going to run into. First up, you've got the hard stop. This is the most basic version. Super simple. You buy a stock at, say, $100, and you set a hard stop at 10% down. If that stock hits $90, your broker sells it. Period. End of story. It's a fixed, absolute line in the sand. And then we've got the trailing stop. Now, this one's a little smarter. It's more dynamic. So let's use that same $100 stock. You set a 10% trailing stop. Now, if the price goes up to $120, your stop loss automatically trails right behind it, now setting at 108. See? It locks in your profits while still giving the stock room to run. So let's put them side by side so you can really see it. The hard stop, that's your fixed safety net. It is pure defense. But the trailing stop is both defense and offense. It protects your initial cash and it protects your hard-won gains. One's a static wall, the other's a rising floor. Okay, so understanding what these things are is one thing, but the real question is how? How do you actually set them up? Because this is not a one-size-fits-all deal. You've got to calibrate your airbag to fit the car and, well, to fit you, the driver. And this is the million-dollar question, isn't it? Do you set it at 5%, 10%, maybe 20%? Because if you set it too tight, you could get kicked out of a perfectly good stock just from normal market noise. But set it too wide, and you lose way too much money before that airbag finally deploys. So where's that sweet spot? Well, finding that balance really comes down to these 5 key things. First, you've got to consider the stock's personality. Is it a pretty calm stock or is it jumpy? Then think about your own timeline. Are you in this for the short term or are you a long-term investor? From there, you got to look at the overall market weather, your personal comfort with risk, and finally, what the charts themselves are telling you. Let's use volatility as a perfect example. For a stable low volatility stock, something like a utility company, a really tight stop of maybe 3 to 5% makes a lot of sense. But for a high-flying tech stock that swings around like crazy, you've got to give it more room to breathe, maybe 10 to 15%. You're basically adjusting the sensitivity of the airbag's trigger. Now, while these automatic stops are fantastic, the pros often use a more hands-on approach for their long-term holdings. So think of this next part as the scheduled maintenance check for your portfolio. It's a strategic framework called SADIF. And to really get why this matters so much, you have to understand the absolutely brutal math of recovering from a loss. Look at this. A 10% loss requires an 11% gain just to get back to even. Okay, not so bad. But a 30% loss? That requires a massive 43% gain. The deeper the hole you're in, the harder it is to climb out. Yeah, just let that sink in for a second. A 30% loss needs a gain of over 40% just to get back to where you started. That's why preventing these big hits in the first place is the real foundation of long-term success. So here's how the SADF approach works. For your core long-term investments, you don't use automatic stops. Instead, once a month, you review your whole portfolio. You categorize your losers into groups based on how far they're down. And the rule is simple, and it is ruthless. If a stock falls into group 3, meaning it's down more than 30%, you close the position. Right then. No questions, no drama.
At the end of the day, you can have the best tools and the best frameworks in the entire world, but none of it matters without the right mindset. This is all about choosing discipline over drama.
And let's be honest, selling a stock for a loss feels awful. It feels like admitting you were wrong, right? We get attached to companies we like. But in investing, being loyal to a losing stock is one of the fastest ways to go broke. Discipline is what protects your capital, not brand loyalty.
This quote just flips conventional wisdom right on its head. Everybody obsesses about finding the absolute perfect stock to buy. But the thing that truly builds wealth is having a disciplined, predefined plan for when to sell. And hey, just a quick reminder before we wrap up, don't forget the other side of this coin. A well-placed trailing stop is one of the absolute best ways to protect your profits on a winning stock. It lets you ride that wave all the way up while making sure you don't give it all back when the tide eventually turns. So let's end on this note. You're never going to be a perfect investor. You're going to have losing trades. I'm going to have losing trades. Stop losses won't make you right every single time. That's not their job. Their job is to make sure that when you're not wrong by a lot. The goal isn't perfection, it's preservation. It's just about making sure your capital's airbag is always on, ready to keep you in the game for the long run.
Okay, let's discuss a little bit about how to manage this idea of stopping our losses before they get too big, and how we should do it without compromising our performance. Okay, let's look again at the two main ways of doing it. From a technical point of view, of course, we can do it by setting hard stops, which means that we define the bottom price that we decrease that we are willing to accept, and the trailing stops, which move together with our with the price, both in absolute terms or in relative terms to the price of the stock. So, and also, of course, we have this so-called volatility-based stop, and some called technical stops based on technical analysis. So technical analysis, well, let's go back to the distinction between hard stops and trailing stops. There are a number of ways to introduce trailing stops, and there are very smart ways of doing that and so on. But personally, I'm not very keen on doing on having stops that are executed by a broker. If you have time, it's better if you trade based on this a change in the performance of your stock, rather than setting an automatic stop with your broker. But in some circumstances, say if you need to go out and you can stay in front of your computer and you wish to set a stop, of course you can do that. Also in some markets, let's say if the market is open during the night and you are sleeping, so you are say if you are trading in Japan and you are a European or American, and so you're not awake when the market is open. So very often it's advisable to introduce some stop order. So it's okay that you in some special cases you should do to introduce in your broker a stop, whether a fixed stop or a trailing stop. But ideally you shouldn't do that. You should decide when to enter your order, whether it is a market order or time limit order or one of the other types of orders that we have in your broker. In relation to volatility-based stops, they can also be useful, but again, it's probably too time consuming, and volatility, you need to be aware where the stock is in relation to a given time horizon. And even if you think that the stock, for instance, has trading between, let's say, minus 20 and plus 30%, so you have to identify where you are. Are you close to the plus 30%? Or are you close to the minus 20%? So it makes sense to, let's say, introduce another stop loss when you are already at the bottom of your price range. So you see, the important thing here is really you can't introduce a volatility-based stop unless you clearly know what is your current position in relation to the volatility that you expect for that particular stock. And whether you can, of course, use your entry price as to measure where the stock is right now. And you can also use the last price as well, but you have to fix that. So in a way, it's a bit can be a bit difficult to run a volatility-based stop. Of course, you can do try to work out a program and then automate it. That's no problem with that. Again, the same with the technical stop. If you have it's called a technical stop, it's a stop based on so-called technical indicators. In a way, our own alpha ratio that we use to identify sell stocks that should be sold is a kind of technical indicator as well. So in that case, what we suggest, if you are using a SADIF's alpha ratio, then of course you should do it periodically. You can, for instance, do it once a week or even daily if you want. And as soon as a stock comes up identified as a sell, what should you do? Then you should not not connect immediately to your broker and sell it without thinking twice. No, that's not the way to do it. What you should do is then go and review the stock, do a short, a fast due diligence, and then on the basis of your conclusion from that due diligence, you decide whether you should sell it or not. So but don't jump immediately to sell it just because the alpha showed a sell signal. So it's just a signal. So you should just jump on that without looking at other factors as well. So this is the main recommendation that I will make to you. Of course, you have to be aware, as we already spoken about that, you always have to be aware about the psychological barriers that we all have. And in fact, we can probably look at some of them here. And be careful to some of those psychological barriers. Usually they come in a form of some kind of loyalty to some stock. So when we get attached to a given stock, either because of its brand, so we tend to become sort of blind to changes in that stock, and then we try to be more lenient when accepting that the stock goes down without taking action. And the other, of course, is that we can whether we think that we should act quickly, because we can always re-enter the market. Let's say the stock has fallen by 10%, but that's a type of correction that many stocks have. So let's say a stock has fallen by 10%, and you decide to sell it because you expect it will fall much more than that, but in that you can re-enter again. So especially it is one of your favorite stocks, let's say, like the one mentioned here, Apple, that you you decide to sell Apple and you intend to buy it quickly. But when should you buy it again? Is it when it has fallen 5% or when it has fallen 10%? So you have to set up then a re-entry price in the, of course, a period during which you think you should re-enter the market for that stock. But again, you have to be careful not to do it too frequently, otherwise you become really a high frequency trader rather than a long-term investor. But you don't need to forget completely about the stock. You can always go to the SADIF platform, to your manager account, and see the stocks that you sold, and see if it's enough time has passed already, and if the stock really is changing or the stock's perspective is improving, and you can decide to re-enter the market. Sometimes you get a bit do the opposite. It's once you sold a stock, it's basically like a divorce, and the divorce is forever, so you don't want to meet your ex again, and then you don't go back to that stock anymore. That's also a very extreme position. So, but very often we do a little like that. So we sold a stock, we don't want to hear about it, and we forget about that. The other suggestion is that you can always set up a watch list in your platform, where you put those stocks that you consider that it might be worthwhile re-entering into those stocks. And that is very useful, but you have to, and I find I quite recommend that say you sold a stock that you liked, you think the stock was fine, but for some reason was going down, and you expect to re-enter, then you create a watch list of stocks to re-enter. And if you monitor that watch list, and when you see that the stock is moving, is starting to recover, then again you should go back and examine, do a proper due diligence, whether that rebound is just a small rebound, or it is a sustained rebound. And if you think it's a sustained rebound, then you shouldn't hesitate and re-enter that stock again. So that's something that you also have to keep in mind, to make sure that you do. And creating a watch list is really a very useful tool for that. Of course, you can also use some other instruments, like by setting rules based on valuation. You know, some of the famous investors work a little bit like that. Say if you sold a stock, but you think or you want to diminish your position in a stock, and you think that the stock was too much misaligned with its valuation, then you can go and look at the chart we saw, where we looked at the intrinsic value and relative value in relation to the current price, and then you may decide whether it is a good idea to change your position in relation to that stock. Is actually also a methodology to decide whether you should sell your stock. Is a very good methodology. Okay, so just to remember all these methodologies, let's first go and look what do we have in both in a brokerage platform and in the SADIF platform. I think I have the somehow open here. Okay, so in relation to the to the kind of stop losses that you may introduce into your brokerage. Interactive Brokers is quite generous on that. I think they have something like 100 different types of orders. You have all of them here explained in this site. So you have some of the trailing limit plus market, trailing limits, and so on. They always say where this type of order is available in a given market or a given platform. You have to be aware of that. So if you want to go from away from the simple orders of a market order or a limit order, which are the simple and the ones that we recommend. You should always go, if you, let's say, they have different types of orders here. What you can do is, if you want to learn about one specific type of order, like this adaptive algo, for instance, if you want to do some of this, what you can do is practice this type of orders. You go to your paper account, and then you do some trades using this type of order entry system. So again, you see that a brokerage typically gives you the tools to place your order in the market following one of these rules or algorithms. But this is different with the choice of what kind of trailing limit you're going to use. So for a trailing limit that you have to set, for instance, you need to understand what kind of range you want to consider. Is it a 5%, 2%, 4%? And that requires a little bit of knowledge about the volatility of the stock in a very short period of time. For instance, you may find useful to go to a chart in your broker and look at some of the technical indicators, and especially, for instance, the rate of change. And you see what kind of rate of change you can expect in within a day, for instance, for intraday trading. And based on that rate of change, then you can set up your limits based on that range. But it's really an empirical study, and varies depending on the moment that the market has. So it's normal that it depends on the market how it does. Okay, coming to the SADIF platform, what do we have here to manage? Well, we have our famous, probably not so famous, but our what we think is the most important, most useful tool, which is our alerts. And you see our alerts for stop losses. Let me see a link here. Okay. So here we have, for instance, a stock, a red alert for Microsoft, which tells us that we should sell Microsoft in this portfolio. This is actually the portfolio of our stock picks in the US. And the one that is doing, it's performing, the worst performer is Microsoft. So we have here, and also some company called ADMA Biologics Inc., which also has a red alert. So how was this red alert? It was defined by this criteria that we use, that if a return to market is below 70%, so that means that in terms of alpha, in terms of our alpha ratio, the stock has lost at least 30% in relation to the market. So it is below 70% here. It will turn into an alert here. Okay, should we have this alert translated into a a stop order in our brokerage, as I said before, not the best, probably not the best way. If you do a bit of a due diligence analysis and you come to the conclusion that right, we should sell Microsoft right now, so you then show to the broker and enter a sell order for your position and close your position rather than relying on a automatic stop loss order. So that's what you should do. But again, even if you look at this case, you may eventually, it's interesting to look at this because it happens with Microsoft that we enter the stock at a bad time. So it was actually a bad call. When we called Microsoft, we did the back call. So why we did the back call, I don't remember now. And we don't know why we did the bad call, but probably some of our strategies were suggesting Microsoft at the time when we did it. This was in August last year. In August last year, somehow we got a tip from our system suggesting Microsoft. We'll have a look at the company. It seems to be reasonable, but we got completely wrong. And the reason why we think that we got it completely wrong is because the stock never really even went above the market. It was always below the market, you see, 96. So this gives us something to think about, because it wasn't just a matter of the stock turning red. It's a matter that we probably made a bad decision for a start. Now, if you look at this one here, the next one, this ADM, we have the exact the opposite. This was in March last year, 1 year ago, and look at this. We have a fantastic. It seems to be a great choice, you see, because the stock actually exceeded at some point when it was at its peak. It was 64% above the market. So great choice. So no mistake here. But then we made a huge mistake, which was that we stayed with the stock even after we should have stopped it. So we probably got one of these yellow. First of course, we got the green alert. We didn't do anything. Then we got a yellow alert. We didn't do anything again. And now we have a red alert, and we still have it here. So was it a bit stupid on our part, wasn't it? So why we so fixated on this stock, which already lost us 28% of its value? And why are we so fixated on this stock? Is there any evidence that we should stick to this stock that went sky high, then come fast also down very fast? Of course, we need to do a careful examination in this stock. We should go to our due diligence tools, see what's happened with this stock, and if it's our fault that we didn't act faster, as we should act faster. And in fact, we can do it quite easily here in the platform, because I can change here the period. You see, I can choose a different date here, and I can see exactly periods when I got the green alert, when I got the yellow alert, and so I can see and can go back and see what I was thinking when I got a yellow alert and didn't do anything. And I can go. This was, 2 months ago or 3 months ago. There was big news about this company, for instance, because this is a tech company, a biotech company, which are always moved by news. So there was this news that we disregard and you should regard. Okay, so I have to go back and see and revise my decision because there was really a bad decision. And likewise, okay, we can look at some other examples. Let's see this one here. Let's see if we have. Okay, so we have these yellow alerts here. One of them is already close to becoming a red alert. Should I already move and do not wait for the red alert? This one also moving very close to a red alert. This not so close, but still very bad. So we have to look at these yellow alerts and see whether I should have or should act now before I get the red alert. But if I get a red alert, then as soon as I get the red alert, based on our rules and our recommendations, we should be a sell. It should be an immediate sell. Okay, so far so good for stopping losses, and it's never too much to remind how important it is to stop losses. It's something that we don't like. It hurts. It hurts our pride. It forces us to recognize the mistakes we made. But it's better that we recognize the mistakes and the bad luck and stop the cost, the rising cost of that mistake, rather than hoping for the best. It's never very good to wait for the best.